And on today's show, how charitable giving can help you give less to Uncle Sam. Part 3 of this week's series on end-of-the-year income tax planning for 2014. With top producers Mike Kilbourn, CLU CHFC, and Rob Odell, CFP. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Innsmark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Rob.
Good to be here.
Mike. Thank you. Day 3, and I highly exhort you, if you're just coming into our show today, that you actually go back out to Monday's show and watch our series in succession. I think it'll be great for your tutorial experience. I mean, chronology is everything. We're talking about charitable giving, and you said one thing in yesterday's show that kind of caught me off guard, that charitable giving now is kind of having a renaissance, because I guess after 2008, money kind of got tight. But now, with everything that's happening in the country, it seems like we're moving in the right direction economically. Seems like charitable giving's up. And you're saying, and you confirmed that yesterday.
We have an up market, and you have an up tax code, and higher tax rates. So that's bringing back charitable planning as a planning tool, if you will.
Well, and Obama has included in some of his proposals to take down the ability to get the deductions for charitable giving. So people are focusing on it now before it goes away or it's diminished somewhat.
Well, walk us through some of the things, because when I think of charitable giving, I think of some of the things. Let's review what we did yesterday just to make sure we're up to snuff first, to make sure the rules of engagement. Then we're going to get into the big part of our show, which is this donor advice funds. Those, I think, is going to be the apex of what we want to talk about.
Sure. Let's talk about the income tax planning benefits that you have. So if someone gives cash to charity, they can deduct up to 50% of their adjusted gross income. So if they make $200,000, they can give up to $100,000 to the public charity and deduct 100% of it, reducing their taxable income down to $100,000. If they give that same $100,000 to a private family foundation, they can only deduct up to $60,000 because that's 30% of $200,000 adjusted gross income. However, the best asset to give to charity is a low basis stock or mutual fund. Now, the rules change slightly there in that if it's a long-term mutual fund or stock that they held, they can deduct up to 30% of their adjusted gross income. If it's short-term, less than 12 months, they can only deduct their basis, but take up to 50% of their adjusted gross income. And so they need to know what the deductions are when you're dealing with the types of assets you're giving to charity.
Right, they can't deduct all in 1 year. Then they have 5 additional years, total of 6 years, to be able to take that deduction.
So donor advised funds. In my opinion, this is probably one of the great low-cost planning tools available to advisors today. In fact, it's one of my best arrows in my quiver, if you will, when I go and sit with a potential client who gives to charity, because this is a very tax-efficient, low-cost way to give.
Is that one of the pre-requirements? He has to already be charitably minded.
Correct.
Okay.
Well, I call it the poor man's foundation. People say, well, I want to have a family foundation, but they realize the costs and the administration and the IRS scrutiny, et cetera, and the excise taxes, and so we show them this donor advised fund concept, and it's actually a beautiful way to handle the issue.
So it's no cost to set up, it's low fees in there, and they can give now. So what happens, you might have clients that have had a good year in 2014 where they've had maybe stock options they've exercised, or bonuses, or signed contracts with their major baseball players or football players, and they've received a lot of cash windfall this year, but they don't know what charity to give to. A donor advised fund can allow them to get the income tax deduction in the year that they need it, and then spread that money to charity in future years.
There's no required minimum distribution to go out to charities, so they can have a year where they give nothing, and they still got their deduction up front, but if they don't give something for a couple of years and then give it, their deduction was taken care of right up front.
So here's in concept how it works. Here you have the clients, during their lifetime, they can give cash or low basis stocks to the donor advised fund, which is a public charitable organization, typically a part of a community foundation. However, the second largest charity in the United States is Fidelity Gift Fund. So they've made a multi-billion-dollar business out of doing donor advised funds. They put money into it, they receive the income tax deduction in the year which they do that. They can sell inside their fund here,
now,
the low basis stock.
Is the deduction complete no matter what size the actual check is?
No,
a full deduction?
A full deduction,
full
but
deduction, okay.
Against the 30 and 50% rules we talked about
and the carry forward
earlier. Correct. So they can sell low basis stock here, pay no tax because it's a tax exempt organization. They can even set up an investment policy statement for their donor advised fund, depending on what the size is. And then at their wish, they can give it out, grants out to 501c3 charitable organizations in the United States.
And they can bring family members into this. I mean, we're talking about their children and maybe their grandchildren, and teach them their charitable views and get them involved in charity. And there's been a lot of studies that have indicated that people, when you have children growing up in that kind of a environment of gifting, they become much better adults.
Well, when I'm looking at this, though, and I'd love to do a workshop on this sometime where we actually compare this idea to Family Foundation.
Correct.
And so if I heard you right, the expense loads on that are quite a bit higher.
Especially for a startup, yes.
For a startup.
Correct.
But this is where people you said they could do this almost immediately because there's all these organizations that are already existing.
Correct.
Right.
They can set them right now. In fact, that would be a very good workshop to do. I'd love to do it because the private family foundation, there's nothing private about it. It's a very public because it files a 990, and I can go out and see anyone's private family foundation in terms of who gives to it and where they give to and what the money's invested into.
And the employees as well.
Correct.
Yeah.
Whereas this is private. They can do anonymous gifts. They can make out to organizations that they don't want to know who the donor is that's benefiting that organization.
As long as the gifts are going out to 501c3 charities,
Correct.
that's government approved charities, and there's thousands of them.
And these are gifts, there's no real income involved in this back to the person who gave.
When this happens right here, it's a completed gift, it's irrevocable, cannot come back, and they lose control technically of that asset, so they get the income tax deduction, but then they advise on which organizations it goes to.
When we come back from the break, we're going to walk through the mechanics of this, really slow it down and unpack this so that we can really understand the beauty of this and how it could be implemented in your practice. We'll be right back after the break. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, I'm with Rob O'Dell and Mike Kilbourn. We're walking through some of these end-of-the-year tax plays, and we're talking about donor-advised funds. And let's just assume that most of our advisors, like myself, I wouldn't know where to begin. Where do you find these people? Are there different types, different kinds of funds? Who plays in this league?
Well, let's first of all finding the client that might be applicable for the donor advised fund. It's very simple. What I do is I look at an income tax return the previous year. I look and see, are they giving to charity? And it's on Schedule A. So if there's more than 3-4% of adjusted gross income to charity, there's a candidate here. Then I look to see if there's dividend income. If they have dividend income, chances are they have stocks that might have a lower basis than fair market value, especially in today's world. So then you have a candidate who can give a low basis stock to charity. And what I find with clients is if they have a portfolio of stocks and they want to give to 5-6 dozen charities, it's hard to fractionalize and odd lot those stocks, whereas a donor advised fund makes it possible.
Okay, so let's say I have my client. They qualify. They looked on Schedule A. They saw he was participating in contributions to his favorite charity. Now I'm going to have to track down a fund. Who's going to do that? What's that?
Provider donor advised
fund. Who's going to provide?
Well, there's three types out there.
Right.
You have the commercial, which is Fidelity, Schwab. They're the big players in the donor advised funds. Then you have the local community foundation. Most local communities have their own donor advised program. And there's one that Mike and I like, which is the independent donor advised fund programs that are out there, such as the American Endowment Foundation.
And sometimes they're a little more flexible in how the family can make these gifts to other charities.
Is there any real specific difference or uniqueness that differentiates one over another that you would actually look at?
Absolutely.
Yes.
The independents are nice because sometimes clients want to give outside a certain area, or they want to have certain types of investments that maybe Fidelity or Schwab will not allow. In fact, that's a big one, is that sometimes independents will allow the advisors to manage the assets even if it's under a threshold of $250,000 or $500,000 that a lot of the bigger commercial providers insist upon before the advisor can be involved.
And some community foundations will only allow you to make gifts within a certain geographical area around that community, whereas others say you can give anywhere in the U.S., any U.S. charity.
So now I know where to go. I have my client. I know where to go. And now I'm going to look at that test we talked about earlier, which is I'm looking at my threshold of AGI. You said 50%, 30%. You were looking at those two areas. So let's say I'm within that framework. I'm under the restriction, the cap.
Correct.
Now I'm ready to make my contribution. I give it to the donor fund.
Correct.
Donor advised fund. And now they're going to put it, and I still get to elect?
You get to advise on which organizations it goes to.
Now I want to make sure I hear that right now, because advice sounded like I lost a little control there.
You did.
I did. Okay, so walk me through that.
But it's pretty rare when the community foundation or the public charity doesn't follow your advice. Of course, they wouldn't get too many more people to form these, fund these donor advised funds. So they usually will take your advice and send the money where you direct it. And as I said, there are some community foundations or ones that handle the donor advised funds that are more flexible than others, so you just sort of have to shop. But the good news is most of them are very accommodating to families, and they'll do it for more than one generation. Now there are some that say after 2 generations you're sort of done, we'll make the decisions after that. But there are some that will take it as long as your family is willing to make those decisions as to where the money goes.
Okay, so I still get to advise. I technically have a little loss of control here, but if I didn't really get my final wishes, who would do the continuing contribution? Who would do it?
The grants, you mean?
Yeah.
Well, who would we elect? So if you have children, grandchildren, they can come involved. We have clients that they have family meetings around the holidays, and they sit and they decide how this money is going to be granted out from their donor advised fund. And they vote shares, and they make presentations in front of the family.
Even the grandchildren's. In fact, Rob has a client where they had the grandchildren stand in front of the family seniors, and actually they had to fill out a full-page description of what they wanted to do and why they wanted to do it in front of the family members, and then they would all vote to see if that charity got that donation amount from.
Wow, so this could be very
powerful.
Your family's participating in quite a level.
Correct.
Right, there's more flexibility. For example, if you were in church and you wanted to make a donation in the basket, you think, well, I've got my donor advised fund, what am I going to do? Well, remember, you already got your deduction, but now you're trying to point the funds somewhere. Well, you can put a note, or actually some community foundation donor advised funds allow you to write a check or a note, and that note gets sent in, and they send a check to the charity, in this case the church. And in fact, I had one of these, and it actually had the Kilbourn Family Foundation on it, but it was nothing more than a donor advised fund. But the check, nice big check, and it had that.
So if I understood this right, and maybe I was a little misunderstanding this as well. If I understand what you're saying, I really can have my own charities in advance. I'm going to the community, or maybe I'm going to Schwab or whoever I'm going to, and telling them, like in your example, I love my church. I want to make sure it goes on while I'm living and into perpetuity, whatever I want to do here.
Correct.
I do want to give to it. So I don't have to do something that's already been qualified as a public giving area. I can do something private, like my own church.
Correct. Well,
Right.
a church is a public
501c3 charity, yes.
Oh, and so because of the filing, that's what makes it qualified.
Correct.
Now, in your practice, how many clients implement this tactic? Because is this a tactic just for the upper middle class and wealthy? Or
No, not at all.
No.
I'd say about 40% of my planning clients have something charitable, and often it's a donor advised fund. And this is not mutually exclusive to a charitable remainder trust. In fact, it complements a charitable remainder trust, and it complements even a private family foundation for income tax planning.
It's really the simplest way to make gifts to charity and not have to deal with trying to make those decisions to which charity right today, but just get the deduction, which makes good sense. And don't forget, you have this year plus 5 more to spread your deduction over. So if you put a big chunk in and you can't use the deduction all in 1 year, you can certainly spread it forward for 5 years.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. I'll see you tomorrow.